Hey guys, super happy to be here once again. And today I'm very excited because we're going to be talking about volatility options market and diving deep into the market itself and to actually receive a pure context of a fund manager and how it's like managing a fund, running an overseas fund, right, Aaron? You're running an overseas fund, so how it's like managing teams in parallel when you are working in different time zones and so on and so forth. So we certainly have great discussion that expects that's supposed to come right now. So I'm very excited. And before we start, Aaron, thank you for coming. I'm very happy and grateful for the opportunity. So before we start, how are you today?
Oh, doing great. Thank you very much. Thank you, Afek, for having me here. I'm
Uh,
excited. I think we'll have a
that's a
good talk.
pleasure. We will. So we will have a great talk. Now, before we're going to be starting our great talk, I really want you to tell everyone who are you?
Um,
Something about your background, you choose. But let's start from there.
yeah, sure. I am originally from Turkey. I have a background in computer engineering, and I started my
Yeah.
career in actually like defense industry in Turkey back in early 2000s. But I always had a passion for markets, so I ended up moving to US to do a
I have a
graduate degree.
question.
Yeah, what's up?
I have to interrupt. Early 2000. You were
2000s.
starting your career.
Yeah.
Really? How old are you?
Oh, I'm 39.
Oh no, really? I would give
Yeah.
you 28 or something. Like, look, guys, I'm really not joking. He looks way younger than his actual age. So yeah, that was surprising for me. Yeah. So let's get back to your presentation.
Um, yeah. So I came to US to do a graduate degree, and ended up just doing a master's in financial engineering. Then I started working. I started working at an investment bank. I was at Goldman for a while. Then I moved to a few hedge funds. So I did that. I started as like my career on the as a quant. Then I later on I moved to trading and portfolio management. And we started OneEye Capital slowly a couple of years ago to consolidate. I do a lot of proprietary trading in different markets. So OneEye Capital, the first thing we did was consolidate them under us, and we are then later on we started offering solutions to outside investors
Hmm.
um, in like volatility focused strategies. So that's been the path. We're very tech focused, just like a like mostly like engineering and tech focused shop. We everything we do is you like we do run discretionary strategies as well as quant strategies, but everything is I would say like process driven, very quant focused, heavy quant focused.
So look, let's make a certain differentiation because here in the podcast we speak a lot about quantitative approach to tackle the market, how to exploit patterns, and so on and so forth. But a thing that we do not really talk about is discretionary trading strategies. And I would like to ask you, Ern, what do you think, or first and foremost, I would like you to provide me with your insight of discretionary traders, with not discretionary traders, discretionary trading strategies. I'm sorry, and I would love you to explain about the differentiation and the diversity it brings you as a fund manager, and how you tend to manage your fund and accumulate it, accordingly to both type of trading strategies.
I guess is this a good time for me to read my disclaimer before we dive into that?
Please, yes.
Yes. Yeah. The views and opinions I express today are my own and do not necessarily reflect those of OneEye Capital, its affiliates, employees, or investors. This conversation is for informational and educational purposes only and should not be construed as investment, legal, tax, or accounting advice. Nothing discussed today constitutes a recommendation to buy or sell any security, an offer to sell, or a solicitation of an offer to buy any interest in any fund managed by OneEye Capital, or advice tailored to any individual circumstances. Any forward-looking statements reflect my views as of today and are subject to change without notice. Past performance is not indicative of future results, and any references to specific securities, strategies, trades, or markets are illustrative only. Listeners should consult their own qualified advisors before acting on anything they hear today. All right,
Brilliant.
I think we can
So
go now.
uh, we
Yes.
can. So, just ladies and gentlemen, this is not a financial advice, as you said. Just let me summarize everything that we're going to be discussing today. Just our professional insight about how things supposed to work, and what do we think? What do we think about other things and other ideas and other interpretation of new type of methodologies to attack the market. That said, we will not share anything that will have any relation to financial advice and so on and so forth. So, with that said, Aaron, let's go back to our discussion.
Yeah, so like back to how we overlay I guess like discretionary strategies with our quant business is rather simple because like most of our quant approaches is trying to optimize like relative value opportunities in options markets, and they they each have their own risk profile. And there's the risk profile that is, like where you would choose to statistically model, you based on simulation scenarios, historical periods, etc. And but there's also like the outside world that's going on. Like if there are like geopolitical tensions, if there are political tensions that can affect the market, you don't have them embedded in your model, but they're out there. So we use almost like we have discretionary overlays on top of everything we do. Sometimes it's to capitalize on an opportunity. We think like it could be like a tactical approach. Hey, we think this is this price of A needs to be here if B and C are over there. Or sometimes it could be, well, our models are already exposed to this, and we think the probability of that scenario happening is increased now. So we should hedge our positions more than we normally do. And these are all fundamentally discretionary overlays on top of a quant strategy. Sometimes that shows itself as like normally, let's say our signals tells us to be positioned size, let's say X amount. But if I think that X is too aggressive for the current like macro outlook or like some political risks involved in the markets, I would like use my discretion to adjust the sizing. Like instead of putting other trades on it, I would still run the same strategy, but with different sizing parameters.
So let
So like
me, yeah, I just want to tackle with a question that you have mentioned, discretionary overlay. Now, discretionary overlay on top of your screens and software, I guess, do I refer your term properly? Is that what you're actually working with?
can you repeat that one more time, please?
Yeah, I was asking if you have an overlay, like a discretion overlay on top of your quantitative strategies that enables you to control it with much more professionally using the overlay.
Yes. So like again, everything is sized and allocated within the grand scheme of our portfolio and strategies. So it's everything is allocated to where they fit as far as like their like P&L risk profile and everything goes. Um, so it does end up being like part of the same overall portfolio.
Mhm. And okay, so we spoke about the differentiation between quantitative approaches to discretionary approaches to tackle the market. Now, I would like to ask you, let's go deeper into the discretionary type of things. Now, I would like you to provide me with an in-depth picture of how you tackle different discretionary trading strategies. So in terms of what do you look at? Is it in terms of a political situations, or I don't know, like a much more
Well,
concrete distribution of the market that you're actually referring a discretionary
um,
strategy over?
sure. Well, at the end of the day, I know as much as anyone else. I don't have, obviously like we buy research from providers who are, um, like following certain areas, certain regions, or certain markets very closely. But at the end of the day, I I have as information as much as anyone else. What we do is, given given what the landscape is, one, what does how does market price these events? Like what are the I mean, being an options trader, you think about world and everything in terms of like implied probabilities. And so what we do is we look at all of these potential outcomes of like price and I guess event distributions in terms of like a market's lens. So like where does market price probability of oil going here, or where does market price uh 3 month forward probability of like S&P going up or down 20%? Like where are these based on those we come up with a picture of what market thinks, and things the interesting opportunities arise when you look at these things in a cross asset from a cross asset perspective. So a lot of times each market has its own internal dynamics, and they price things
So,
within
so
their internal supply demand imbalances and dynamics.
So
So
how do you sorry, but I really want to take that direction a little bit more into a deeper layer. So how do you actually constitute a picture of how the market is actually working right now? Because you have mentioned cross asset, you have mentioned a few financial factors. So how do you constitute everything into one coherent understanding of how the market is actually tending to move right now?
um I guess it's again we we never try to sort of like guess where the market will move. Like we never try to make strong assumptions, but our assumptions is that, let's say, um, equity options imply a certain probability distribution for future prices, and and both I guess like a median level or and a distribution. And same thing happens in interest rates, oil, commodities, and these assets have relationships with each other, which obviously break down or strengthen based on what's going on. So we take a scenario approach, um, in a way that, okay, um, S&P implied probability of, let's say, scenario X is this. Um, for oil, it's for let's say oil rising another 20% is here. Um, Gold collapsing or rising is here, and interest rates, let's say 2-year rates going to 5% is here. Um, and then you try to like we basically try to find relative value opportunities or like richness, cheapness in a way. Well, if interest rates, 2-year rates are at 5%, and if oil is let's say at like 130, what happens to S&P? And if market
Hmm.
is pricing in a um, 30% probability of us seeing those levels, it should also assign similar probability of, let's see, S&P experiencing like major correction or like a big move down. Um, Again, this is simplified, but like we have basically based on like inflation. Inflation obviously is a big part of like what comes into these models, like inflation rates and like on like global cross asset relationships. We um, try to find again relative value opportunities, and these mostly happen like we look at these things just to protect our like existing strategies. So in a way, let's say we do this analysis and we think, well, S&P options are very cheap right now, so we may want to buy like S&P variance. Well, we may actually be short in our strategies for completely different reasons. But let's say the macro picture tells us that S&P options are the cheapest way to protect yourself. So that could reflect itself as us um, lowering our short S&P volatility exposure um, because of, like just to protect ourselves again in this scenario. We think we need to be um, like not too much exposed to. Because like the other thing we want to do in general is that given that we're a very small fund with a flexible mandate and running mostly proprietary strategies, we want to position ourselves, we want to be in a position of strength during times of stress so that we can like scale scale up our exposure to our like stronger signals, because like when markets move, that's when our systems fire a lot of signals, and we want to be well capitalized and not be in defense at those times. um, so again, like finding the balance between, again, like there's always something potentially going on out there, and you can always like spend money on hedging yourself. That's also like a trap we're trying to avoid. So like we're always trying to find good trades to again protect our quant strategies, and that would position us in a way we can deploy more risk if there's an actual stress event happens.
Hmm.
Um, Obviously, this is, like this is what we try to, and this is our approach when we are being a young shop. We're still like building out a lot of our stuff. Like we are trying to cover more markets, more event scopes, like look at different things. But this is the fundamental approach we take when it comes to, use our discretion to either like overlay our portfolio or size strategies in a different way. Um, yeah, so
It's actually fascinating how like people think differently. So I have a lot of quants here and a lot of quantitative minds here, especially chief investment officers, CEOs, and every pipeline is it's not drastically different, but it's drastically different in a way that you think of it. So the architecture itself is like different, not by its component, but the way they relate to each other and the way that like the leader of the fund likes to invest in the market. Now, I want to go back onto your example. I wanted to ask you, okay, so after you have multiple signals, and we know that you work with overlays that will enable you to actually, make your system a lot more interpretable, so you can actually change or work with your system in real time. You have as an output, a lot of signals. So from that area onto actually entering a trade or entering a position, I wanted to ask you what is like the bridge that what bridges the gap between a strategy that exploits a lot of different signals. What type of signals does it exploit? So it has its own signal. So and you have like a counterfactual lab that will hold like in a superposition much of a different trading signals, and then you enter a trade. So what is that you're actually doing from the situation you have trading signals to deploying them into the market, and how do you hedge yourself, or how do you tend to lead yourself onto a very direct business goal with your existing trading signals.
Sure. Well, I guess one aspect of hedging we talked about, like being aware of what's going on in the world, and having some like macro awareness on top of everything we do. But fundamentally, like the way we look for signals and we execute them is always from a like risk and portfolio allocation perspective. So we generally our models work as ensembles. Let's say we have an ensemble of 12 uh, orthogonal signals, and based on current market conditions, we weigh them
Hmm.
differently. So again, like so the way we build our process, it naturally overweights the more attractive signals versus underweights the less attractive ones. And again, we try to structure it in a way because like when does a signal become less attractive? It's usually when it works, right? Like when, let's say, you put on a trade. Let's like it's not something we do, but let's say you think, oh, Apple is a buy here, you buy it. Like as its price goes up, your buy signal weakens. At least in our case, our signals usually weaken when our trades work. So like so in that sense, a lot of stuff we do are in more like mean reversion family. So a lot of our signals weaken as our trades work. And as they weaken, you reduce the size, which results in you basically locking in P&L. And signals strengthen when let's say you're positioned 10% of your portfolio in a signal that is weak. Let's say that signal strengthens, which usually means you lost money on that 10% allocation, but now you can actually size it up at a more attractive level. And let's say now your portfolio optimizer tells you to be 20% in that strategy, and you size up your allocation at a more attractive level. So this way we try to, again, be in a position where we lean on good trades and we continuously bank on P&L, and we kind of protect it.
Hmm.
Obviously, like this mode, there's a like a very small portion. So this mode is like it's a general like mean reversion scheme. but it's like not all of our signals are mean divergent. We have a lot of like trend momentum based signals as well, but our weighing scheme fits them into this landscape. And obviously, you have a lot of thesis failures, your signals weaken and stop working, and we continuously monitor regime shifts. Does our stuff work as expected? Because let's say you have a model, its expected return is X amount under a certain period of time or certain set of conditions being met. And let's say those conditions are met, like what did you realize? Like is your model still is reality still in line with what you do? So that's again like these like nothing pretty much everything we use is ever evolving. Again, markets evolve, relationships change, and in that landscape, that's why like we're at work all the time, trying to one make sure everything we do is still sound, and two, we're always searching for new sources of alpha. I guess the most important thing is like you need to be looking at things either in a very different way than the way other people look at, or you need to be looking at completely different things. Like, and one is, I guess, like having some edge in information. Like if you have access to information other people have, sometimes it's like super expensive data sets, or some other kind of edge. In our case, a lot of times our edge, I would say, is looking at things in a way other people do not look at.
I get it, and I would like to dive into a really interesting approach that will, take that conversation a lot deeper. I would like to talk about alpha research. Now, you're obviously a very small fund. You don't have all the tech stack that you need in order to exploit all the patterns. And obviously, that's a very expensive process in general. And I would like to ask you, how do you actually extract alpha that actually works, that you are able to hold for a long period of time and have a proper yield out of it? So, what do you do in order to extract alpha? And how do you identify or recognize when the alpha is getting weakened?
Well, luckily, I guess for me is that we are um in the age of like great technology, and the tooling enabled by AI is also has been very instrumental. One thing, we are small, but actually our engineering background allowed us to consume data sets, and like span markets and data that a fund our size normally would never be able to. Like, for instance, we don't like we build everything in house. Our hardware is in house, our servers are in house. So like we own our own metal in a way. So we don't have massive cloud storage costs, computing costs, GPU costs. We run everything in our own hardware. We store everything ourselves, which is actually like I would say 10 to 20 times cheaper than your average build out of a shop that either uses like cloud VPCs or buys latest and greatest hardware and collocates into a data center. Like we buy secondhand servers, we buy our CPUs from auctions. So we did a lot of basically hustling to build a tech infra that is competitive. Like we process options, tick data, we save them, store them, digest them. Like I have access to live vol surfaces. We can actually like generate signals from them, trade them. So I think our like strong engineering background allowed us to compete in a way, not necessarily compete, but allowed us to like even build out and like an analytical framework that would normally not be possible for anyone. And on the other side, there's like there's like great offerings. Like everyone has better APIs now. Everyone has like better solutions catering to financial institutions. In and the I guess the third leg of what allowed us to actually, like build a lot of stuff with a small team and limited resources has been, we utilized the tooling offered by the advent of LLMs quite well. Again, they don't, they're not going to make you, they're not going to find you any signals, new trades or anything. I guess like, well, some people
Mhm.
try to use it that way, but we like as far as tooling goes, we actually are very like we kind of position ourselves as an AI native hedge fund, because like we use those tools to be more efficient um at everything we do. So like we I guess like one, we did the hard work of building everything ourselves, and we utilized everything the world has to offer to be able to, like process really large data sets. Like we have near half a petabyte of data. Like your average macro fund doesn't store that much data.
I get
And
it.
like so like we did the hard work, which kind of slowed us down from like if we were better funded, we could have just went out there and maybe started taking sizable risk a lot sooner. But we like at least I took the other approach of like build your own everything in house, slow but steady. But then that gives us an edge. Now, like we are very cost efficient, which our investors love, how cost efficient we are. Um, and if we want to scale into something, we can like we're very agile, like we can really scale into it without again dialing up the costs extremely.
Mhm. Well, I wanted to ask about the profit margins that your guys are able to have, because you have everything in-house, like all the clusters and all of the hardware, software. I guess that everything is built to serve you, so it's like a proprietary asset that you guys own. And I want to ask you about like the curiosity that investors show, which is a direct reflection of what you have just described, which is like having everything proprietary, everything open. And I want to clarify with you, how do you actually see their curiosity increasing? Like in what term do you like to get pitched? And how do you manage and raise funds in general with the architecture that you have and the infrastructure that you have created?
Yeah, I like generally it's when we're talking to potential LPs or like GPs, it's always part of our pitch that we like a lot of times, um as these costs grow, funds charge LPs like their top line returns these costs. And I guess like as we when we talk to them, like one advertising point for us is that like we will one, we are like very like conscious about it. Two, we are like we have the skill set. So like not a lot of institutions have the skill sets to run their own clusters for machine learning, data processing, risk and analytics. Two, they don't like, or you can hire people, then you have to manage with people, and these engineers are like extremely expensive. So in our case, I can act as the CTO and CIO at the same time. Not that I do too much development, but I'm actually like, I understand everything that needs to happen. So I can be like on top of all the build out, as well as, um, and that also helps you because I'm also the one building the strategies and managing the portfolio. Like the way I look at infrastructure is very end goal focused. So like a lot of times, a lot of in my career, I've seen this all the time. Your CTO and CIO and CRO and CO, like these four C-level executives, they need to get on the same page when they're trying to, let's say, decide on how to budget for infrastructure, what to build first, what to build last, how to build it, etc. um, because they don't always have the full picture of what's going on the other side, or what's the actual objective. Uh, a couple of things can happen. One, either like a lot of time is spent to get everybody on the same page so that your CTO has the full picture of what the trading needs. Um, or you waste resources. You do something, the end result is not what's expected, and then you do it again. You do it again. Like just like either projects take very long, they cost a lot, and they actually don't deliver. I've seen this multiple times in my career where even in like relatively small organizations, um, this like lack of communication and like people living in different universes um, hurts efficiency a lot. I would say one edge we have, an important one we have, is that like me, I can actually like build this whole thing. I can build my own data pipeline. I can build my own risk and analytics. I can implement all those signals, and I can actually go out and trade them. Like right now, my focus is on obviously like managing the portfolio and coming up with like new strategies. But fundamentally, I am able to do the whole stack, which then when I'm talking to engineers, I know exactly what they need to do. When I'm talking to our CTO, I tell them, well, that's great, but like that's not a day one priority. You will
and
see
and
that
and,
it's
and
not a day
that's
one priority, and like that makes us like very very efficient. So we waste very little time on nice to haves. We we go in the wrong direction a lot less frequent than some other projects may experience.
so that really converges into the next topic that I wanted to chat about, which is actually running a fund overseas. Now you have a team, if I remember properly, in India,
No,
correct?
we have a team in Turkey.
In Turkey, and
Yeah,
you have a team
so
in
we
the
have a
United States.
yep.
How complicated it is?
It's not very, again, most of our team is from my undergrad institution, so culturally, it's very coherent. Time zone is a big problem. Efficiency is a big problem. But I guess I work around the clock, so I'm generally available for them if they need me. Um, it is a challenging lifestyle, but we make it work. Um, and I guess like one thing, one thing that is a challenge is to have everybody um excited about markets in a way that I am excited about. Because like sometimes when you are like away, I guess like if you're being in New York versus not being in New York, like affects people's or at least being in a financial hub. Like if you're in London, New York, Chicago, like in talk to, interact with market participants on a continuous basis. Uh, the urgency you have, the things you overhear, the things you you basically live in that uh I guess idea pot in a way. So being outside that makes a lot of what's going on in the problem domain abstract to people. So I guess the biggest challenge is to um, keep people motivated and excited about markets. Um, so it's a two-way street. Like a lot of people who are doing this business needs to be excited about markets, because at the end of the day, yes, you are using your engineering, you're using your like physics, math skills to solve problems, but these are not academic problems. These are all the purpose of us working all these problems and coming up with new models is to solve a puzzle. So I guess like the biggest challenge is to have people go into this mindset and be excited about working in that environment. Um,
What environment are you actually referring to? Because look, first and foremost, there are tons of different amounts of environments, and even to every environment has its own sub-environments, and every sub-environment look different, and not just that it looks different, it changes every single time. Now, I would like you, how do you actually leverage your quantitative skills and actually deploying strategies like for you, Aaron? What is the pipeline that you're like the critical thinking pipeline that you're actually leveraging uh, to come up with new trading strategies? What is the process that you're taking?
um, One, I guess understanding, first of all, especially in options market, it's like the very first step is understanding the general market dynamics. Who are the market participants? What are their general objectives? What's their trading behavior, frequency, hedging needs, etc. So that is one picture. Obviously, if you have complete picture, that's great, but you generally don't have complete picture. And that's one. And two, understanding like empirically understanding how a market behaves under certain conditions, and how a market, I guess, like how different parts of the market evolves in, I guess, like time dimension, price dimension. So
Hmm.
there, I guess, if you think about options as, the probable the entire distribution of an asset can take in time, that's what, again, there's like time dimension, which moves at constant speed, but the price moves at different speeds. So in those two dimensions, can we like adapt to how this can do we understand how this market evolves based on different scenarios of underlying and time. Um, so we do a lot of empirical studies to make sure that we break down how markets price options and each risk component in a way we can understand. We can intuitively understand, and we can attribute P&L to. And once we do that, then we have a good understanding. Okay, if I know 1 month 25 delta call options, let's say I have like a three-factor model of the empirical distribution. And let's say I think 1 month 25 delta call options are um, structurally rich because of factor C. Then if I have that isolation, then I can find, okay, there's some revenue opportunity there. There's like structural richness over here. Uh, one, okay, I will start collecting that structural richness. Then you look at, okay, what does this look like? You know, a lot of times in option strategies, you are actually um, again, like breaking down is important because you want to make sure like equities have a momentum. Like equities almost always like go up because of like, you know, companies grow, countries grow, inflation. So like there's a bunch of components that cause that, like, you know, like general like growth in equities. And if your source is your source of P&L, that, so like again, like stripping that out is a big component for us to like find pockets of opportunities, because like that is usually the biggest trap where you are uh you have something that looks interesting but that's actually like long or short, like beta, or like directly short vol. Like they're like, you can run into traps where a lot of times optically a strategy may look long wall, but it's actually short wall in a way. So it's like a lot of effort goes into uh, breaking down everything and having a good understanding of, you know, price and vol dynamics for us to break down the market into tradable components. And once we do that, once we are like, again, it's an ever evolving process. Once we have that, the next step is to, okay, then you look at relationships. Like then you look at relationships across different equity indices, equities, sectors, commodities, or like credit. So once you go into that, then like one, you have a good idea of let's say you factorize the risk and return components of an asset. Then you do this for multiple assets. These two assets sometimes have very strong relationships, sometimes have weak relationships. And then based on that, you, within our tradable universe, we basically have holistic portfolio targets. Like I want my annual P&L volatility to be, let's say, 5%. And my
Mhm.
return target is, let's say we're targeting like uh, 3 sharp. And for that to happen in today's market conditions, with this factorizations, give me the optimal portfolio. So that simplifies things a lot. Again, that also folds into our earlier discussion of like we want to lean on to attractive trades more. Um, this model allows us to actually, like, it naturally ends up trading the most attractive trades a lot more while still keeping you at your risk and vol target limits. We obviously have, because wall targeting and traditional risk metrics have their weaknesses, we always cap our exposures based on like strict limits. Like we don't want to have more than a certain amount of like gross notional exposure. We don't have more than a certain amount like gross vega exposure. We run a lot of like stress scenarios to make sure, okay, like under let's say like you apply stress shocks to your portfolio. We apply, okay, what happens to this portfolio in GFC? What happens to this portfolio in Feb 18 Wix blow up? What happens to this portfolio in April 2025 tariff crisis? What happens to this portfolio in COVID? Based on all
Mhm.
these filtering and stress, we basically end up with an optimal options portfolio, and we allocate it, like we deploy it. Sometimes we, again, I add discretion of like I want to deploy this full size, half size, or like actually even go more aggressive. But a lot of times the output, like the eventual portfolio that is deployed is this, and we manage it. We manage, obviously, a lot of research and effort goes into optimal rebalancing, optimal delta hedging. Again, you can hedge these options portfolios. Your exposure changes every second. So as your exposure changes, how often do you want to rebalance? How often do you want to hedge your delta? How do you want to hedge your delta? Or how do you want to hedge your Vega? So there a lot of things you can do very differently, and everybody does it in a different way. Everybody does it in a way they think is efficient, and we do too. So we're constantly doing more research on finding different dimensions to again look at the markets to evaluate these opportunities and make decisions around rebalancing and hedging.
Mhm.
It's an ever evolving process. And yeah, so like our fundamental approach is to like instead of like not necessarily run one strategy, but like uh build enough tooling and understand and decompose markets in a way that strategies and attractive trades show up themselves. It's easier said than done, but that is our aspiration and overall approach to trading.
I get it. So let's talk a little bit more about hedging because I see that it's like motive within your proposition and how do you explain things. And I would like to dive deep into your hedging process and how do you think about hedging in terms of position and how it corresponds to the portfolio itself and from the portfolio going back to the position. So how do you hedge the position, looking at the portfolio, understanding the relationship of the hedging on top of the portfolio and going downwards from the portfolio and breaking down into actually understanding uh, um, everything that corresponds into the single position that you're holding.
Yeah, well, a lot of times, again, like options have many different components that move their prices. And I guess the most fundamental one is delta. Like if you buy a call option, if the market goes up, your options price will go up. But our general approach is to not make money from delta because we're like not in the business of guessing like market direction. So when we like first like none of the options we trade are like naked in that we always hedge our delta exposure. And how much delta exposure you're hedging is again it's a complicated question, because that's where all the modeling, factorization, understanding how options, uh, all options available for an underlier evolve and perform in a way. So like that comes down to again like breaking down your risk factors in a trade and choosing which one to be exposed to.
Mhm.
And a lot of times, again, it's different. What we choose to be exposed to is different for every building block, I guess, like every sub strategy we have constituting our portfolio. But a good chunk, like I guess, like a very good chunk of our quantitative work goes into um, decomposing the risk you take because again like let's go back to that like call option example. um the market, like you buy it, the market goes up, your option price is like most likely going up, you're making money. Or the options implied volatility goes up and
Mhm.
you may still make money, like the market may stay the same, But the option, like let's say people start buying these options left and right, and the market makers will keep selling them for more and more. And you will simply make money because there's a lot more demand for these options, or there's like something showed up on horizon that makes that option a lot more valuable, and actually the underlying price did not change. So that's another risk factor that affects the price of your option. These are, I guess, like the most basic ones, right? Your delta and vega, and the other component is decay. Like every option loses value as time passes.
Mhm.
Um, and so what we do is we decompose again, like we and there are many other sensitivities. Like as you decompose an option, one you have your delta, vega, theta, then you have your gamma, like how much your sensitivity of delta uh, to change in price. So you can go through this risk composition of an option, and then you do this for every option on the surface, and you find which risk sensitivity you want to be exposed to and how much. And you build a portfolio that ends up being only exposed to that risk sensitivity, that sensitivity you want to be exposed to. Because
Mhm.
if you have no idea where the price is going, but if you think the options are expensive, um, you want to sell the option. But even if the options are expensive, if you just sell the option naked and the price goes, get back to that call example. If the price goes up, you will lose money. So if you like, but you may be right and not lose money because you were not hedged properly. Um, so like in a way, like you want to like what we do is like we pick uh what we want to be exposed to and we hedge everything else.
Mhm. Very interesting. So after you are doing that predefined selection in terms of the grades, and you refer it to hedging and going in depth with the hedging process, and starting to think about market signature and market regime or shift. I would like to ask you, how do you, much more forensically, um, how do you know how to derive the rightest factors, or the rightest Greeks, with a direct relation to how the market responds right now?
It's reactive. We don't like guess. We obviously have
That's
again
that's obviously.
um so we try to adapt quickly. So like that's why
Hmm.
we invest a lot in our infrastructure to catch any shifts in market dynamics quickly and adapt our processes. So we basically are again like let's say there's this. I guess a good analogy is there's this car wildly going down in a desert, and we're basically trying to stay right behind it, so that we're always, like adapting to its behavior, and we are not affected in a negative way. And then we try to, monetize that arise along the way. So, like again, the markets are ever changing, ever evolving. The world is evolving all the time. Um, we obviously have like a probabilistic models of again one market has this implied probabilistic model, and we have our empirical models on top of it to assign a probability of each of these scenarios happening. But at the end of the day, one thing happens and you need to adapt to that thing. We just try to stay agile and on top of everything that happens that affects our trading universe, and yeah, stay profitable.
Mhm. Very interesting. Let's go back into the culture. You've spoken about your culturistic environment because you were hiring like your classmates. I wanted to ask you about how it's like working with a very unique workspace culture like you have on a far distance, and how you are assessing risks properly in relation, not in relation to the culture itself, but in how do you assess risk in the context of understanding the market, and how do you transfer the message throughout your team, and how do you deliver like final result by the end of the day using such a productive and proactive team that enables you to run very fast.
Yeah, I guess it comes down to good communication. We do a lot of case study like examples. Like we go over, let's say everybody's focusing on like different specific projects and everything. We do have our frequent sessions of be going over a trade, or a strategy, or explaining the market dynamics so that like everyone has some sense of awareness of things that are going outside their universe. We have our we have our stand-up meetings where everybody explains everyone else what they're working on again, so that people are always in the loop. Um, and that's one. I guess like again, back to our thing again, being in a small firm, it's naturally everybody uh has to know about everything, which sort of makes it easier in that and again, like we our team members are all people who are very excited about markets, and they are eager to learn and discover. So it sorts itself out. Like if people are interested and they're willing to learn, and if there's good communication, um, you naturally progress towards that common destination of building a great firm.
Mhm. Okay, so Aaron, let me go into something that I love talking about, which is machine learning. What is your approach about machine learning? How do you tackle machine learning? How do you incentivize your people to think about machine learning? And how do you deploy it eventually when you trade the markets?
Well, we use machine learning tools and techniques in pretty much like every step of our workflow.
Hmm.
We use them in portfolio optimization. We use them in regime classification. We use them in uh, signal calibration. Like we use them in uh, like empirical option pricing as well. So like they go into different ways, different techniques. They go into um, different problem domains, but we heavily utilize them. Another reason why we have our own hardware is to be able to utilize them without accruing heavy costs of running them in the cloud. Um, it is Yeah, it's a fundamental tool kit we use to make better decisions. Like a lot of times, like a lot of methods and signals starts with one market intuition, then they turn into heuristics, and from heuristics, uh, they turn into like in let's say a heuristic model we have applies really well or translates really well to a machine learning framework, then we do that translation. We don't all like one thing we try to, at least I try to stay away from, is losing intuition and explainability. So like sometimes, especially on the research side, we end up applying sophisticated models to improve our signals. Um, it, Oftentimes when we get small improvements, or like small improvements are easy to get, but like a lot of models that offer small improvements we do not use because you lose some explainability um to like your like source of signal or like factor. um and there are some other times where that's okay, like where let's say if we're doing the regime classification, the
Hmm.
weight of inflation of that regime classification uh being zero point 0.3 versus 0.3, 0.35 optimized by your deep neural network is okay. Like I do not have full intuition behind, oh, like why its weight should be here versus there. But that weighing scheme yields a great result in, as far as regime classification goes, I'll use it. So it's but if I'm trying to explain my P&L and I get noise, I get improvement but lose a lot of explainability, I am not going to use it. So it is it is again part of like different machine learning techniques are used all over our infrastructure for various purposes. And we basically try to use them fitting their purpose and where they fit us. And we obviously constantly strive to make better uses out of them. We are one of our advisors is an like ex Google machine learning engineer. He helps us apply. So basically, like when we have complicated problems and our limits are like knowledge of the domain is limited, or like we hit a wall, we
He
have like
comes. He,
like
he comes to help.
we have exactly we have this brilliant advisor who helps us, well, do A B C D, and then like it opens another route. So yeah, it's again, as I mentioned earlier, we try to position ourselves as an like an AI native hedge fund, where we use all the tools offered by, again, latest advents of like machine learning and AI tools at everything we do. So yeah, that's all of your machine learning algos are part of our toolkit. We use them where we think they will help us make better decisions, or like improve our processes.
Brilliant. Now, I would like to dive into the last conversation of today's for the last topic of today's conversation, and I would like to shift towards fundraising. I guess you were in various fundraising rounds, and I would like to ask you, how do you approach investors nowadays? What do you think that, increases their curiosity at the most? Um, what do you think that, incentivizes them to invest within your fund and not with your competitors? How do you differentiate yourself so you enable investors to actually look and say, "Oh, he's unique. We might to go with him." Although that market is highly competitive.
I agree. And it's been like uh, so far we're very recently um trying to launch a like larger vol business. And so far, our investor outreach has been people I know.
Hmm.
Um, so like the interest is coming from just knowing you. But overall, hopefully next time we talk, we will have made a lot more progress on this front. But overall, our approach has been some of the stuff I mentioned, that we are like a very cost efficient, agile firm, and we offer investors a suite of strategies that are only available to elite buy-side institutions, and not all of the investors have access to those institutions. So, like one of our pitch would be like one part of our pitch is that like the way we run and manage risk is obviously it's not at par, but it is like in line with how it's done at elite institutions. And I know it because I've been there, I've traded there, and I've helped them build these things. And we are trying to, we're like, giving you access to the same suite of strategies and risk management rigor. At the end of the day, like it's like it comes down to like risk management and appropriate like risk management and allocation. So like that is one of the biggest differentiating factors of like your top tier elite institutions versus your average fund manager.
Hmm.
And our one of our I guess differentiating factors is that we approach like we take a risk first approach, and everything is driven from like how much risk we are consuming and what does that look like. Again, like macro awareness is also like part of this. Like we're not religiously believing in our models and like just trading them. We are like highly market aware and like adapting ourselves continuously. So that's basically our I guess like a good chunk of our pitch. Like we're very uh tech focused, uh with deep understanding of options markets, and we are like great at managing risk and allocating capital to the best strategy possible at any given time. So yeah, that's
That's
the
brilliant.
that's the overall approach.
That's brilliant. Okay, Aaron, I would love to thank you for your participation. Actually, you're the kind of the guest that comes and they expose everything. So you actually you actually made my work a lot easier. So I was very thoughtful when you were speaking. So I thought about what you were actually intending to say, and after you said it, I tried to digest it and to think about my area of improvement. And I thought that it is a great conversation and obviously great opportunity. So I would like to thank you for it.
Yeah, thank you, Afik. This has been great. Yeah, it was great. I'm glad we finally did this.
Yeah, me either. So, again, thank you for coming. I appreciate it. Thank you for all the listeners. And until next time, ciao.
All right, thank you, Afik. Bye.